Greetings, Grade 12 learners, and welcome to today's accounting lesson. My name is Mr. Simbi, and this lesson is brought to you by the Gauteng Department of Education in collaboration with Saibono Discovery Center. It is exciting to have you in my class today, and I am looking forward to a very exciting class, and I am looking forward to you doing calculations and asking questions if possible, so that we can all move together. In the past weeks, we've been having lessons. I'll be very delighted to know that you've been attending these lessons. And if you have not been attending these lessons, you will still be able to access the links and then you can still be able to access these lessons. We've covered the statement of comprehensive income and we did several adjustments. We've also covered the statement of financial position. And today we are going to do another statement of financial position again. All right, so here are my objectives for today's class. We will touch on a bit of theory. I am going to explain what is the CEO and the CFO. And then I will complete the statement of financial position. So it is very important that you have the worksheet. We are going to be getting our question from the NSC November for the year 2020. And there's a very exciting statement of financial position in there that we're going to do together. So if you have the worksheet already, it is good that when I do calculations, when I do write certain figures, please write together with me. I'm not going to be fast. I'm going to be doing it so slowly so that you can follow me as well. So to begin with today's class, I'm going to define what is the CEO and the CFO. Okay, so we're going to start first with our Chief Financial Officer. That is what CFO stands for, the Chief Financial Officer. All right, this is a senior executive who's responsible for managing the financial actions of a company. All right, so this is a senior executive in a company, and the main responsibility is to manage the financial actions of a company. They typically oversee financial planning and analysis, financial reporting, accounting, treasury functions, and risk management. The CFO plays a crucial role in strategic decision making. All right, this is very important. So they play a crucial role in strategic decision making by providing financial insights and foresights to the company's leadership team and board of directors. So remember, we're still talking about the CFO. Should have seen this term in your past exam papers or when you were studying. So we're trying to unpack more on this CFO. Furthermore, we'll say they are responsible for ensuring compliance with financial regulations and maintaining the financial health and stability of the organization. So you'll find that in some questions you'll be asked that the CEO was asked to do 1, 2, 3. Should they do that? So you should know that they are responsible for ensuring compliance with financial regulations. So there are some actions that we do not expect the CFO rather, to be engaged in, such as bribery. We will not expect the CFO to be doing such because they are also responsible for ensuring compliance with financial regulations and maintaining the financial health and stability of the organization. So this is the Chief Financial Officer, the CFO. I'm hoping that one of these days you guys are going to study and further accounting and hopefully become the CFO of a particular organization. Yes, you can do that. That is very possible. The next one is the CEO, that is our Chief Executive Officer, the Chief Executive Officer. What is the Chief Executive Officer? This is the highest ranking executive in a company responsible for making major corporate decisions. All right, so the highest ranking executive, this is our CEO. And then the CEO manages the overall operations and resources of the company. So it is the responsibility of the CEO to manage the overall operations and resources of the company. So all the resources are managed by the CEO. The CEO also acts as the main point of communication between the board of directors and corporate operations. And then the CEO sets the company's strategy. That is very important. When the company is to set a strategy, we are relying on the CEO. So he sets the company's strategy, the vision, the direction, and works closely with other executives and managers to ensure that the company achieves its goals and objectives. So what we're busy doing today, before we get to the statement of financial position, was to talk about, number one, the CFO, that is the Chief Financial Officer, and secondly, the CEO, who is the highest ranking executive in a company. Now, for you to be able to complete the statement of financial position, format is very important. And for you to understand format, we're going to take it from the accounting equation. That is, our assets are equal to owner's equity and liabilities. All right. So assets, this is how you invest the business's funds. Okay. So assets are equal to shareholders' equity plus liabilities. How did we raise the money? That is the capital. All right. And then as we go further in explaining the format, it is very important for you to know that we have what are known as assets. And our assets are split into two. First, we have what we call non-current assets. These are your tangible fixed assets. All right. So we'll do a note number 3. You will see in today's class that we're going to have a note called note number 3. This is a note to the statement of financial position. All right. So you will prepare this note and then you get figures that you then show on the face of the statement of financial position. And then your non-current assets, these are assets that are not bought for resale, but are to be used in the operations of the company, and they would last for more than one financial period. That is your tangible fixed assets. But we also have what are known as financial assets. We are talking fixed deposits, investments in other companies. All right. So the total of your tangible fixed assets and your financial assets, that is the fixed deposit, they give us what we call our non-current assets. Then we also have what are known as current assets. So you can see here, these are non-current and these are current assets. Under our current assets, we'll start with inventories. That is your note number 4. So your inventory note is note number 4. After inventories, we come to our trade and other debtors. We're talking trade and other receivables. All right. That is note number 5. In today's class, I'll show you what we can enter or record in trade and other receivables. And then we also have cash and cash equivalents. This also includes a fixed deposit that is maturing within 12 months. I want to encourage you to look for last week's class. In last week's class, I explained this aspect here. So you should go and watch it so that you can also understand. All right, let's continue. So after we have this, then we're going to have our total assets. For our total assets, it is our non-current plus our current assets. That is what gives us our total assets. Let's go on. We have now covered our assets, so we go to the next part, which is our owner's equity and liabilities. On the owner's equity, we will begin first with capital and reserves, that is our shareholders' equity. And our shareholders' equity is made up of two things. The first one, it is your ordinary share capital. And we open note number 7. In today's class, we're going to open again note number 7. All right. And then we'll say our ordinary share capital plus the retained income. All right. Which is your note number 8. All right. And then there's a financial indicator which we can calculate once we get to this point. So during today's class, I want you to remind me, okay, to show you this specific financial indicator which we can calculate once we have this amount, that is the shareholders' equity. After we have our shareholders' equity, remember these are the new items that we see in grade 12. We would then come to what we call non-current liabilities. That means on liabilities, we have two different types. The first one is our non-current liabilities. These are liabilities that the business will pay for more than 12 months. So in other words, they will exist for more than one financial period, such as your mortgage bond. Okay, so their maturation period is longer than 12 months. That is our non-current liabilities. After our non-current liabilities, we would then have what are known as current liabilities. These are debts, therefore, or liabilities that will be paid within 12 months. So I would say this is 12 months and less. And under our current liabilities, you have first trade and other creditors. This is your creditors and other businesses that we owe, and other items such as when we receive income in advance. I'll show you in today's class. And then under current liabilities, you also have bank overdraft. This is when you have withdrawn more money than your current bank balance. So in that case, you actually owe the bank. That is a bank overdraft. And then you have what is known as short-term loans. Okay, so this is a portion of the loan that will be payable within 12 months. Okay, there are other items that can still come in here, and we're going to see that today. All right, already you're thinking, Mr. Simbi, why are you not touching shareholders for dividends? We're going to be recording it as well. All right, and SARS income tax if we owe SARS. Keep that in mind. All right, so at the end of the day, then we're going to have total equity and liabilities. Total equity and liabilities. That is what we will then have over there. All right, now how can you get easy marks when completing the statement of financial position? Remember, all this that we are doing, the end result is that when I write my March test, when I write my June exam, my prelim, and my final exam, I must get as much marks as possible. So our idea is for you to get as much marks as possible. And if you're to get marks from your statement of financial position, you should know the format. So you cannot take the risk of going to write the exam without knowing your format. That is number one. So you would always start with the amounts that are from the pre-adjustment trial balance, and then after that you go on and do your adjustments. Okay, and when you are doing that, you look at the amounts that are in the balance sheet accounts section, and then record the figures. And then once you record those figures, then you can now proceed with adjustments. Okay, you will see in today's activity there are amounts that are also in the nominal accounts. The amounts in the nominal accounts will also require us to do certain adjustments, and in today's class we're going to do that. So remember, you need the worksheet. If you don't have the worksheet, it's not a problem. You will be able to follow through. But for those who have the worksheet, just make sure that it is the NSC November for the year 2020. And what question are we dealing with? Question number 4. All right. So I hope that you guys are ready. And if you guys are ready, then we're going to start. Make sure that your calculator is closed. All right, because we're going to do certain calculations. But if you can't find your calculator, all right, then I'm going to also show you how to punch in your calculator from this side. But I expect you that you must have a calculator every time. That is very important. All right, so if you're ready, let's begin. The information that we're given is question 4, fixed assets and financial statements. So you see, our fixed assets can also be part of the statement of financial position, as well as these fixed assets can be seen in other questions as well. Here we see it on the statement of financial position. And this question was to fetch 65 marks, and we're supposed to do it in 40 minutes. But I'm going to be slow, so I'm going to take more than 40 minutes because remember, there's many of us here and you are going to be following the calculations. The company's name is Avengers Limited. The information relates to the financial year ended 31 March 2020. Very important. Okay, so we are used to a financial period which begins 1st of March and ending 28 February. That is what we are used to. But in this one, we are told that the financial year ends on the 31st of March. All right, so what does that mean? You have to be careful. It means this financial year had began on the 1st of April, 2019, for it to end on the 31st of March 2020. Very key. All right, so don't make assumptions when you go into the exam. You should be able to read your dates, and you should be able to understand if it's ending on the 31st of March, it began on the 1st of April the previous year. If it's ending on the 30th of June, it began on the 1st of July the previous year. Are you still with me? So don't assume. Read the information, understand it, and then you can understand what the examiner wants you to do. Required. Refer to information B, calculate the missing amounts denoted 1 up to 4. So we're going to do that one, as well as prepare the following notes to the balance sheet. All right, that is your ordinary share capital. Can I ask you a question? What note number is the ordinary share capital? It's note number 7. Thank you. So ordinary share capital is note number 7. Then we're going to prepare retained income. What note is retained income? Note number 8. Thank you so much. That is note number 8. And then finally, we're going to complete the statement of financial position. All right. So if you guys are ready, let's see the information that we were given. We were given an extract from the books on 31 March, and we were given 2019 figures and 2020 figures. So these are two separate years, 2019 as well as 2020. You have to understand that you are preparing the statement of financial position for the year 2020. But in certain calculations, we will need the 2019 figures. Can I go? All right. And then you come here. You find that we have an incomplete fixed asset note. This is note number what? Thank you. This is our note number 3. All right. Note number 3, tangible assets. So we're going to do certain calculations. We're going to calculate for that one, this one, that one, and we will not forget number 4 as well. Okay, let's go on. This is additional information. We're not going to read it now. We're going to read it as we attend to the questions. And then you also have information C, which relates to our share capital. Information D speaks to dividends. And then we have up to information J. Okay, let's begin now with our information B. Information B, remember, is talking to our note number 3, which is our tangible asset note. This is note number 3. You have to understand that whenever you are dealing in note number 3, you can split it into about 3 parts. 3 parts. So you have the first part, which is your carrying value, your cost, and your accumulated depreciation. So this can be one part. Then you also have your movements, additions, disposal, and depreciation. So these 3 make the movements. So this makes another part. And then lastly, you have this one here. That is your carrying value, your cost, and your accumulated depreciation. That makes then the third part. So we have about 3 parts to this note. All right. But what we want to do is to calculate this cost here. What that means is we have to be able to understand why we have the 850 in brackets. But we're given information which says a building on a separate property was sold at cost. So once we have sold an asset, we will show it under disposals, but it must be in bracket. That means that asset is no longer with us. It has been disposed. Are you still with me? Remember, there are several ways in which we can dispose an asset. We can sell it, we can trade it in. You remember that one? Okay, we can sell it, we can trade it in, and it can also be involved in an accident. Are we together? I just spoke about 3 over there. Now, this asset has been sold. But after we sold that asset, we are now left with assets worth 9,650,000. That simply means whatever we had here at the beginning, so this is my cost at the beginning, will be more than my cost at the end, because I have disposed an asset here. Can I say it again? We have assets at the beginning, which is your number one, which we don't know. So we have an amount that we don't know, which is your number one there. And we have disposed an asset, that means we have sold an asset with a cost price of 850,000. After we have done that, we are now left with 9,650,000. So I can call this number one. Let me call this number one because it was number one in the paper. Okay, so this is my number one. When I have my cost at the beginning, which is number one, and I take out an asset, I'm left with 9,650,000. So it simply means if I want to know what is my number one there, I will simply take this 850 on the other side there. So it therefore becomes that it is equal to 9,650,000. Then I'll say plus 850,000. I'm going to add the 850,000. It therefore gives me, do you have your calculators ready? Okay, how much do you get? You get your 10,500,000. You get 10,500,000. That becomes the answer to number one. So we had 10.5 here, and then we sold an asset for 850. That is why we are now left with 9,650,000. Okay, so we've done number one. I like the fact that you have your calculator close to you and you're doing some calculations. All right, let's see now if we can do number two. Number two, depreciation. Okay, so you know that when we calculate depreciation, how many methods of depreciation are there? Two. What is the first one? The cost price method. With the cost price method, you calculate, all right, I'm just going to write here. So when we calculate depreciation, we have the cost price method. And with the cost price method, we calculate depreciation on what? On cost. And the second method, it is your diminishing balance. Okay, and with the diminishing balance method, remember you calculate depreciation on the carrying value. Now here we must calculate some amounts. Okay, now we are told that we have a new vehicle bought. Whenever we calculate depreciation, we have to know that our assets can be split into three. Our assets can be split into three. That is your sold, your old, and your new. Your assets can be split into three. That is your sold, your old, as well as your new. So we are told that here we have a new. That means this one that is at the beginning, that is the one that becomes my old. Let's start with the old then. Let's come and calculate the depreciation for the old. We are told that depreciation is at 20% per annum on cost. 20% per annum on cost. So I'm going to take the cost of the old, which is my 1,281,000. Then I'll say multiply that by the depreciation rate, which is 20%. 20 over 100 multiplied by 12 over 12. This is my old. And once there is no sale, that means my old will be there for 12 months. So it will be 12 over 12. And then, can I please see on your calculator, how much are you getting when you calculate that depreciation? Say it again. You get 256,000. Say it again. 256,200. Thank you. 256,200. This is for the old one. This is for the old one. But I told you that you must calculate for the son. So far we have the old. What do we need now? We need the new. All right. So with the new one has a cost price. But I can see here there's no cost price given. But I know that once I have my note number 3, I am able to see if I have a new. Additions, these are the new assets. Additions are the new assets. So I'll come here, then I'll now say new. All right, the new one. What is the cost price of the new? 625,000. All right, so we now need to calculate depreciation for this. Then we say multiply by 20 over 100. Multiply. We now need to know for how many months we have had this asset for. Remember what I said at the beginning. When is this financial year ending? It's ending on the 31st of March 2020. So we bought it on the 1st of January. That means we count January, February, March. Then the financial year ended. So it ended when we had used the asset for 3 months. How much? Let me see calculators, please. Calculators. How much do you get? You get 31,000. Say it again. 31,250. 31,250. That becomes the depreciation for the new. I know that when I come here and I want to get my depreciation, I must be able to add those two amounts. The first one is the old, which is 256,200. So I'm going to come here. It's going to be my 256,200. Then I'm going to say plus. Plus which one? Plus the new. So I have my old, I have my new. I have my old and I have my new. My new is 31,250. 31,250. That will give me the amount here. And then how much is that going to give me? That is going to give me 200 and, say it again, 287,000. So number 2 is 287,450. That is the answer to number 2. 287,450. Okay. Can I move on to number 3? I can move on to number 3. Okay, let's move on to number 3. So before I move on to number 3, number 2, what was key? Remember your son. You calculate for your sold, old, and new. But in this case, we don't have sold. That's why on disposal is the sold. So here you see there's a 0 here. So we don't have an asset that is being sold. But we have the old, which is this one here. We have the new, that is my addition. Are we good? Thank you. Let's move on to the next one. We're going to calculate number 3 now. Number 3. Oh, and number 3 is coupled together with number 4. Okay, let's see how we can work this one out together. All right. It reads, equipment at cost 21,000. Okay, so make sure when I am reading, you're also following what I am reading. Equipment cost is 21,000. Was sold on 30 September 2019. So now we have what? Once we hear the word sold, we're thinking what? Disposal. We're thinking disposal. All right. The accumulated depreciation was 15,000. So this asset had accumulated depreciation on 15,000. 1 April 2019. What is 1 April 2019? This is the beginning of the financial year, considering that it ends on the 31st of March. Equipment is depreciated at 15% per annum on the diminishing balance method. So here we are using the diminishing balance method. What are we required to calculate? Disposals. So you would find that in other texts it would be written disposals at carrying value. You would see it would be written here disposals at carrying value. What that means is we must calculate the carrying value of the asset that we're disposing it at the date of disposal. Let me rephrase that. Please give us the carrying value of the asset that we have sold. Or what was the carrying value of the asset that we have sold on the date of disposal. That's what they are saying here, disposals at carrying value. In other words, we record our disposal here at carrying value. Now, we understand that this equipment had a cost price of 21,000. That was its cost. All right. So I'm going to come here and say it had a cost price of 21,000. That was its cost. And then if I subtract accumulated depreciation, I will get what is known as the carrying value. Carrying value. Now, when I come here, I will see that my accumulated depreciation is given to be 15,000. Yes, 15,000. All right. So that means my carrying value at the beginning of the year, this asset had a carrying value of how much? If you say your 21 minus 15, this asset had a carrying value of 6,000. But remember, we did not sell it on the 1st of April. We used this asset this year and we sold it at a later date. So it could not have a carrying value of 6,000. No, it was used. It had lost more value. Now, we should be able to calculate the depreciation that it incurred in this year now. We are calculating using the diminishing balance. So if you're using the diminishing balance, what do we use? Carrying value. So we come in and we say 6,000, that is the carrying value. Multiply that now by the depreciation rate of 15%, multiply by 15 over 100. Multiply. We want to know for how many months was this asset in the business. We had it running from the 1st of April. So we're going to say April, May, June, July, August, September. Do we count September? Yes, because it's 30 September. So we do count September because it is 30 September. How many months do you see over there? So you're going to get 6 over 12. Multiply by 6 over 12. I need to see calculators close. Calculators close. All right. How much you get? If you say 6,000, multiply by 15 over 100. Multiply by 6 over 12. How much do you get? All right. Thank you. I hear someone say, Mr. Simbi, I get 450 rands. That's correct. Thank you. 450. So, at the beginning of this year, this asset had a carrying value of 6,000. But we used it and it lost value due to depreciation. And that was 450. So on the date of disposal, what was its carrying value now? What was its carrying value at the date of disposal? Okay, on the date of disposal, what was its carrying value? You would now say 6,000 minus the 450. That should give you 5,550. That is the carrying value on the date of disposal. So that should now give us number 3, the carrying value on the date of disposal. That is your disposal at carrying value. We simply want to know the carrying value of the asset that we've sold on the day it was sold. That is our disposal at carrying value. So that would be your 5,550. Okay, that should be the answer to number 3. That is the answer to number 3. Okay, are we good? All right, I'm going to move on from here. So that I can do now my next one. Remember, my next one is number 4. So I'm going to bring a clean piece of paper so that we can do this. Let's do it together. Okay, here's a clean paper now for us to do number 4. Number 4. What is number 4? Accumulated depreciation. All right. So with our accumulated depreciation, we want to know what is the accumulated depreciation at the end. We know that at the beginning, we had accumulated depreciation of 200,000. So we had accumulated depreciation of 200,000. This is at the beginning. Then we used our assets during the year. We used our assets during the year. And these assets lost value due to depreciation, which was 42,450. So it's going to be added now to the accumulated at the beginning. So I'm going to come in and say plus 42,450. That will now mean we now have accumulated depreciation of 242,450. All right. But it is very important to note that there was an asset that we have disposed. Once an asset is disposed, it means we're taking it out of our business books. You have to understand that in this 200,000, there is accumulated depreciation for two separate assets. That is your owed as well as your sold. They are in here. Okay? Your owed, that will remain, as well as your sold is in the 200,000. Those two are in the 200,000. Are you still with me? Now, we understand that we now have 242,450. That is our accumulated depreciation when after we have added this depreciation. But we have an asset that we have sold, and that asset had accumulated depreciation. We must write it off from our business books. Do you still remember? That asset had accumulated depreciation of how much? 15,000. Remember, it had 15,000 at the beginning of the year. And we calculated its depreciation and we got, do you still remember? 450. And we got 450. That means that asset that we sold had now an accumulated depreciation of 15,450. Okay, so if we are to get the accumulated depreciation at the end, we have to understand that this asset is no longer in the business. So we cannot keep it here. We must take it out of the business books. That means I will then come and say minus. Minus how much? 15,450. We are taking it out of the business books because it is no longer with us. We have disposed it. So it's going to be 242,450 minus the 15,450. That is going to give us how much now? 227,000. So you end up with 227,000. That becomes your answer here to number 4, 227,000. All right. So this therefore gives us the final calculation. Now, it is very important that whenever you are given the answer book and you see shaded areas, do not write in those shaded areas. The examiner is simply saying that is not for you. The unshaded areas are the areas that are for you. So in this case, all the other areas we're not supposed to write. We're only going to write in the areas that were not shaded. Okay, I'm going to move on to the next aspect, that once our note is completed, at times you'll be required to complete the statement of financial position, that is our fixed tangible assets. If you would get the total of your carrying value here, the total, that is, if you get all the carrying value amounts, okay? In this question, it was not required. But in case it is required somewhere else, please, you simply add this one and that one and that. That is how you get your 11,458,500. But in this activity, it was not required. The examiner had given us this amount. This amount was given in the answer book already. I was saying, in the event that you're required to calculate it, you are simply adding your carrying value amounts. In the event that you are required to do it, you add your carrying value amounts. But in this particular question, it was not required. We were given the amount already in the answer book. All right, let's now go on to the next aspect. It now says share capital, information C, share capital, share capital. Okay. There is our answer book. Are you ready? Okay, I'm ready. Let's go. We know that when we are dealing with our ordinary share capital, here we're going to be talking about the issued. We're going to be talking about the what? Issued. In the previous, I don't know how many classes, since we began this year, I've been doing this note almost on a daily basis. Every Friday, I try to touch this aspect. So if you need more, please revisit our previous classes. You will find that I've addressed the ordinary share capital as well as the retained income note. We are told that in 2019, the balance was 4,800,000. This was already given in the answer book, all right? But in this answer book, I had not put it in, so let's put it together. So in the answer book, it was given that you had 800,000. 800,000, that is your shares. 800,000 shares in issue, all right? At the beginning. This is at the beginning. And that would give you the 4,800,000. In the event that it is not in the answer book, you're simply taking it from here and you're putting it here. In the event that it is not put in, but in this question, you'll find that your answer book, this amount was already put in for you. Okay, let's go to the next aspect. On 31 May, 400,000 ordinary shares were issued. All right, so I'm coming here to now say, on 31 May, we issued 400,000 shares. Okay, so this is shares issued. This is shares issued at, do we know the price? We are not told. So can we get the rand value here? No, we can't. So let's go on. Whenever you get to such a position, do not stop there. Continue. All right? Then we are told that on the 1st of October, 60,000 shares were repurchased. Okay, so once there's a repurchase, what is the first thing you do? Brackets, you're correct. So I come here, then I put my brackets. Before I even do anything, what do I put? My brackets. Then I'll now say, how many shares were repurchased? 60,000. So I'll come here, then I say, 60,000 shares. These were repurchased. These were repurchased at. Now, I know that whenever shares are repurchased, I will record the average price. But where do I record the average price? Because I'm told that the repurchase price is 10 Rand 80. So it simply means I bring in my triangle in this case. The repurchase price will come to the top. Here is the repurchase price. The repurchase price comes here. How much is that? 10 Rand 80. 10 Rand 80. The repurchase price goes to the top. Okay. Later, in the next couple of weeks, we're going to do something called the cash flow statement. Keep that in mind. Later, I said, what are we going to do? The cash flow statement. We're going to use this amount here. You will see. Then on this side here, that is where I have my average price. Average price. How much was that? 7 Rand. This is what goes to note number 7. But we paid 10 Rand 80. Yet the average price is 7 Rand. So we'll now get the difference. The difference. The difference is what goes on to note number 8. Your retained income, note number 8. How much is the difference? 10 Rand 80 minus 7 Rand. That gives you 3 Rand 80. That goes to your retained income, note number 8. So what do I take to my note number 7? 7 Rand. Why? Because it is the average price. Can I say it again? It is the average price that you record in note number 7. So I'm going to come here and say repurchase is at 7 Rand. Then calculators, please. Calculators. We're saying 60,000 multiplied by 7 Rand. How much is that going to give you? 420,000. Thank you, guys. Thank you. 420,000. All right. And then We then come here and then we now say the number of shares. Can we get the number of shares at the bottom? Yes, we can. All right, so we're saying 800 plus 400, that gives you 1.2 million. Then you subtract the 60,000, that gives you 1,140,000. These are what? Shares in issue at end. Shares in issue, this is at the end. But I don't have a value there. All right? I know now that once I see that I have an average price here and there's no other new issue after that, I can get the value of my shares at the end there. All right? Because I can use now that 7 rand. I can use that 7 rand. So I'm now going to say my 1,140,000, I want to get now my value of shares at the end. So I'm taking my 1,140,000 shares. All right, 1,140,000 shares. Then I multiply this by the average price again, which is my 7 rand. Okay, let's see how much do we get. Then we get our 7,980,000. That 7,980,000 is what I then bring here at the bottom. So I'm coming here to say 7,980,000. That is what I get now at the bottom. How did I get that? Because the repurchase is the last thing. So I can use the same average price to get the value here because the repurchase is the last thing. So I now need to get that value there. Okay, let's see how we can get that value there quickly. For us to get that value, we will simply say, all right, so I'm going to take off everything so that we can do it nicely. We're going to do the bottom up calculation where we start from the bottom going to the top. We want to get that missing blank figure. We will now say 7,980,000. Then as I'm going up, I'm not going to add the 4, I'm not going to subtract the 420 rather, I'm going to add. I'm going to now say plus the 420,000, plus 420,000. Okay? And then what do I now say? Minus the last amount, that is your 4,800,000. And then it will give you your amount at the beginning. All right? Let's do it again. Let's do it again. Let's do it again together. It is going to be your 7,980,000, 7,980,000, 7,980,000. And then what did we do? We added how much? The 420. We added the 420,000. What did we do again? Then we subtracted the 4.8 million. The 4.8 million. There is your 4.8 million. How much do you get? 3,600,000. So that becomes the value for this blank space, 3,600,000. So I'll come here, then I'll get my 3,600,000. That therefore completes our note number 7. Okay. Once this note is completed, we have to know, in mind we're preparing the statement of financial position. So I'm going to go quickly and I'm going to take my amount here, which is my 7,980,000. And then I'm going to bring it now. Ordinary share capital, note number 7. How much do I get? I'm going to record now my 7,980,000. Okay, so I'm not going to wait until I do all the other adjustments. Once I get the figure, I go and place it on the face of the statement of financial position. There it is, my 7,980,000 on the face of the statement of financial position. Okay, let's quickly now go to the next calculation. So in this calculation, we're going to do the retained income. The retained income. Much of the information here was done, such as the balance at the beginning, your net profit after tax, as well as the final dividends here. So what we are going to do here is going to be the repurchase. Thank you. So we're going to say the repurchase of shares. How many shares were repurchased? 60,000. So I'll come here, then I'll say 60,000. Then we multiply by how much? Is it by 7 rand? Is it by 10 rand 80? All right. Remember what we did with the triangle. We said the repurchase price comes here, which is 10 rand 80. You remember that? And here we said we bring the average price, which is how much? 7 rand. You remember that? And then we said we're going to get the what? The difference. How much is the difference? 3 rand 80. Where did we say this goes? The retained income. This goes to your retained income. So that means I'll come here and I'll say 60,000 multiplied. 60,000 multiplied by how much? By your 3 rand 80. Multiply by your 3 rand 80. Okay, and then once I hear the word repurchase, I keep in mind brackets, brackets all the way, brackets. All right, calculators, please, calculators, calculators. 60,000 multiply that by 3 rand 80. Of course, I'm not going to show you my calculator for this simple one. I want to hear how much you get. Here are the figures again. 60,000 multiplied by 3 rand 80. How much you get? Thank you. You're saying 228,000. You're very correct. 228,000. Now, we now need the ordinary share dividends, and we know that that amount is going to be subtracted as well. But for us to get that, we must calculate our interim dividends. And we're told that interim dividends of 124 cents was paid on 30 September. So on 30 September, how many shares were we having? Because 30 September is coming just after the 31st of May. So that means we're going to give the interim dividends to 800 plus the 400, 1.2 million. So we're going to come and say our interim, we take the 1.2 million shares, multiplied by the 124 cents, 124 cents. Now, it becomes tricky if you multiply by 124. You have to remember to divide by 100 again. So if you don't want those complications, you simply multiply by 1 rand 24 cents. Okay, 1.24. And then how much do you then get? Say it again. 1,488,000. 1,488,000. Very important there. Okay, so if you multiply this by 124 cents, you are about to get a very big amount. Then you have to divide by 100 again, so that you come back to 1,488,000. Or you can simply multiply by 1.24. That is 1 rand 24 cents. Then we're going to add these figures now. We're going to add these figures. All right, that is our 1,488,000 plus our 889,200. Then we're going to have our 2,377,200. Okay, then we can get our balance at the end. How do we get that? We are now saying, okay, we're going to quickly do that together. To get the balance at the end, we're going to say our balance at the beginning, which is 1,181,250. Then we add. Okay, let's come and add. Then we say plus. Net profit after tax, 2,534,400. What else do we do? Then we minus our 228,000. Remember the repurchase, 228,000. Then we subtract again the 2,377,200. The 2,377,200. And then we will get our balance at the end, which is 1,110,450. 1,110,450. That becomes your balance at the end of the retained income note. Let's quickly bring that amount now. We want to bring it on to our statement of financial position. So I'm going to come here now and I'm going to bring now my 1,110,450, because I already have this ordinary share capital. So I can get the shareholders' equity amount. I can get the equity amount. And for me to get the equity amount, I'm just adding those two. So I'm going to end up with 9,090,450. 9,090,450. That is what therefore becomes my shareholders' equity. Now, when we are here, all right, I know we're busy with the statement of financial position, but what if I now introduce you to a financial indicator called the net asset value per share? Net asset value per share. In the following lessons, I'm going to explain this financial indicator clearly. All right, we want the net asset value per share. And for us to calculate the net asset value per share, we will take our shareholders' equity, which is your 9 million here. So I'll say 9 million and 90,450. Then we divide it by the number of shares issued. Then I divide this by the number of shares. My 1,140,000. Then I multiply by 100. I always want to encourage you by 100 cents, because your answer must be in cents. Your answer must come out in cents. Okay, punch in your calculator. How much you get? You get 797 cents. I know you get other figures coming in. I just wanted to introduce you to this exciting financial indicator. You're going to see this very often. Most of you might have seen it in the past exam papers, called NAV. What is this? It's called the net asset value per share. All right, so later when I'm going to be unpacking this financial indicator, I'm going to tell you exactly what does it mean when we say net assets. What does that mean? So make sure you don't miss the following classes, because I'm going to be unpacking this as well. In today's class, we're simply saying when you are to calculate your net asset value per share, you take your shareholders' equity, which you get when you add note 7 and note 8, that is your 9 million and 90,450. Then you divide that by the number of shares in issue, or number of issued shares, which we find in our note number 7. And then we multiply by 100 cents. Your answer must be in cents. As you see here, your answer must be in cents. Therefore, we are done with this part here. Can we go on now? Okay, let's go on. Let's go on. All right, so we have an adjustment now which relates to the loan. And we know that we are going to record under our non-current liabilities as well as our current liabilities. And then we are told that we have a mortgage loan with the Grandeur Bank. In 2019, it was 3,150,000. Then in 2020, it was 2,508,000. Okay, so what we are supposed to do is to read the additional information and understand it as well. And this information then reads as follows. Fixed monthly repayments, including interest, have been made and correctly recorded. Okay, so the fixed monthly repayments have been made and correctly recorded. Interest of 258 has been recorded by the business. Sorry, let me read it again. Interest of 258 has not been recorded by the business as yet. So when we come here to our non-current liabilities, we will now say our loan will come, and then we take the balance in 2020, which is your 2,508,000, your 2,508,000. And then we have been told that interest has not yet been recorded by the business. That simply means I'll come here and I will add my interest, which is 258,000 plus my 258,000. Now, we know that we are going to be paying this loan because we make fixed monthly repayments. The capital repayment will remain the same over the next financial year. So the capital repayment will remain the same. Now, we want to know how much was paid. That is, the difference between this loan in 2019 and the loan in 2020. In other words, we are saying the difference between our 3 million here, our 3,150,000. Okay, let's do it together. All right, the difference between our 3,150,000, the 3,150,000, and the one in 2020, which is the 2,508,000. Okay, so the difference here is your 642,000. Okay, so we're going to come here and we get our 642,000. That is the difference there. That is our fixed monthly repayments. Okay, so this is the annual, the total amount that we're paid. Okay, and then we know that in that amount we have included the interest. Are we together? So if we want to know the capital repayment, we will now say that 642 minus the 258, which is our interest. All right, the 642 minus the 258. That is your 642. I'm going to say it again, minus the 258. All right, and then it will give you an amount. So let's quickly do that calculation again together. Let's see. If we say the 642, then we're going to come and say minus. Let's come and subtract minus the 258, minus the 258,000. That would then give you 384. That becomes the capital repayment. So we know that the capital repayment is 384. 384 is the capital repayment. This is the capital repayment on the loan. This is your capital repayment. So we now understand that we are going to make the same. They remain the same. So for the next financial year, we are going to make a payment of 384,000. That therefore means I'll come under my current liabilities and I'm going to say current portion of loan. Current portion of loan. And my current portion of loan is 384,000. That becomes my current portion of loan. Some would say short-term loan. It's one and the same thing. Short-term loan, current portion of loan, 384. Let's quickly close that part now. So we took the amount in 2020 of the loan, then we added our interest, and then we subtracted the short-term loan for the next 12 months. And then we're going to remain now with our 2,382,000. 382,000. And then that is what we take to the top as well. That is your 2,382,000. And it ends as such. All right, so we're going to go to the next adjustment. Our next adjustment is on the provision for bad debts. But before we do this adjustment, we're just going to take a quick 5-minute break. So we're going to go for a 5-minute break, and then after this 5-minute break, we're going to resume. So make sure you join in again after 5 minutes. See you shortly after the break. Welcome back, dear learners. Before the ad break, we were doing note number 3 calculations. We did note number 7, note number 8. And guess what? Today we did a financial indicator, the net asset value per share, where we took the shareholders' equity, we divided by the number of shares in issue, we multiply by 100, and remember your answer must be in cents. Your answer must be in cents. And that financial indicator can also be used to prepare the statement of financial position. We'll see if next week we can have something like that. All right. Then it now says on adjustment F, the decrease in provision for bad debts of 2,500 was not recorded. All right. So here we're given a decrease in provision for bad debts. We are required now to take some information. So remember, we are preparing the statement of financial position, and then our inventory amount is not given. So it is actually the balancing figure in this case. But we are also given the cash and cash equivalents, as you can see here, bank favorable. If it was unfavorable, it was going to appear under our current liabilities. You remember I showed you earlier on bank overdraft. But because this is favorable, it will appear under our current assets. We are going to come now and record our trade and other receivables. So I'm coming here under inventories, and I'm going to say trade and, let me write it again. There is our trade and other receivables. Trade and other receivables. Now, on my trade and other receivables, I'm going to take my net trade debtors. All right. So very important that here we are being given the net trade debtors, which is 881,000. So here it's 881,000. And then we are then told that the decrease in provision for bad debts of 2.5 was not recorded. So in this adjustment, we are given the decrease itself. Once you are given it as a decrease, the easiest way is to come and you add that decrease, that is the 2.5. If it was an increase in provision for bad debts, that means you're going to come and say 881 minus the 2.5. But in this case, it simply means our provision for bad debt calculation this year is lower than the previous year. So we have a decrease, and therefore we come to our trade and other receivables, and then because we're given the decrease amount, we're going to say plus 2,500. Let me go on to the next aspect. The next one is now my commission. Remember, we've already done this decrease in provision. Commission income. We are told that commission income for March, that is 41,900, was still outstanding. Because this is income and it is outstanding, it is not been received by us, the business. Therefore, it is a receivable. So I'll bring it now to my trade and other receivables. Then I'll say here plus 41,900. This is commission income that is still outstanding. Commission income that is still outstanding. Okay, let me go on to the next one. So that was G. I'm going to go on to the next one. That is H. It reads, the company has 3 directors. The company has 3 directors. All right. And then, so let's come here and maybe we can make it easy that there is 3 directors. So there is director number 1, director number 2, and there is director number 3. And then one director has not received his fees for March. That means this director number 1, director number 2, director number 3. One director has not received his fees for March 2020 yet. So that simply means this first director has been paid for 12 months. All right. And then this director has also been paid for how many months? For 12 months. But this director has only been paid for 11 because he has not yet received his fees for March. Not received his fees for March. So we paid him for 11 months. In total, the number of months that we have paid is 12 plus 11. All right. How many months is that? That will give you 35 months. 35. So we will then say the director's fees of 2 million. The director's fees of 2,275,000. We divide it by the 35 months. It will give us director's fees per month. And in this case, it's going to be 65,000. Our director's fees per month is 65,000 per director. Director's fees per month per director is 65,000. So we now know that that 65,000 is an accrued expense. It is an accrued expense. We are owing for that. So we're going to come here to trade and other payables. The first thing we'd record is our creditors control. So we come here and then we're going to say our 1,318,000. All right. And then we're now going to add. We're going to add our director's fees that is outstanding. That is my 65,000. That is my 65,000. All right. Let's go on and see. Okay, so before I go on from this one, remember what we have done. We have taken the director's fees. That is not for all the 3 directors for all the 12 months, because one of the directors, we are told here, has not received his fees for March. So one director has received for 12 months, another one for 12 months, but another one for only 11 months. So in total, we've paid for 35 months. All right, when we then take the 2,275 divided by the 35 to get 65,000 per month per director, and then we come and edit here because it is an accrued expense, so it comes to our current liabilities. Let's continue. The next one is an adjustment on rent, and it reads: rent for April 2020 has been paid. The rent was increased by 25% on 1 January. Okay, so we know that our financial year is ending on the 31st of March. All right. If we have paid for April, that means we've paid for more months. Let's do this properly. The financial year begins on the 1st of April 2019 and it ends on the 31st of March 2020. That is 12 months here. But we have paid for another month, that is April. We've paid for April here, another month. So in total, we have paid for 13 months. We should have paid only for 12 months, one financial year. But in this case, we paid for 13 months. Can I go on? We are told that we cannot just take the 364. We can't just take the 364 and divide it by 13. That is wrong. Why? Because the rent was increased by 25% on the 1st of January 2020. Okay, so what that means is there were months whereby rent was not yet increased because it is increasing on the 1st of January 2020. So these months from the 1st of April 2019 until the 1st of January 2020, these are the months that had no increase. The months that had no increase. We know that whatever we're calculating, we're going to put it in the statement of financial position. So we want to know how many months were there that had no increase. So we will count from April, May, June, July, August, September, October, November, all right, December. Do we count January? Because it is the 1st of January. So we're going to end in December. So when we end in December, we have 9 months. Those 9 months, we paid we have rent, okay, we've paid rent that had not yet increased, that is 100%. For those 9 months, rent had not yet increased, that is 100% for those 9 months. And then for the other months, from the 1st of January until the end of April, we have to count now. So it's going to be January, February, March, April. That is for 4 months. We understand that rent has increased by 25%. That means it is 125. So if we take that, multiply by 100, that gives us 900. If we take the 4, multiply by 125, that gives us how much? If we say 4 times 125, that gives us 500. Then we add these two figures. It gives us 1,400. April here is a month after the increase of 25%. So the month that is giving us a problem is 125. So we're going to come and say 125 over the 1,400. Then we multiply this by the rent expense of 364,000. Multiply by 364,000. It will give us an amount. How much is that amount? 32,500. What is that 32.5? That is our rent expense that we have paid in advance. So that means it will come to trade in other receivables because it is a prepaid expense. Once you have a prepaid expense, we come here, then we're going to say plus 32,500. That is a prepaid expense. 32,500. Very, very important. Very, very important. All right. Let me go on to the next aspect. And then the next aspect becomes your calculation of net profit amounts for us to get the income tax. So we're going to calculate income tax. We are told the net profit after tax after all adjustments is 2,534,400. And then income tax is calculated at 28% of net profit. So we know that we have what we call net profit before tax, and that is 100%. Net profit before tax. Then we have income tax. In this case, we are told it is what? 28%, which is 28%. Then we're going to get net profit after tax. Net profit after tax, which is 100 minus 28, that gives us 72%. That is the one we are told. Net profit after tax is the 2,534,000. 2,534,400. Okay, so we are able then to calculate income tax because what we want is 28 and what we have is 72. Okay, so what we want is 28 and what we have is 72. Multiply that by 2,534,400. We want to know how much is the income tax for the year. The income tax for the year is 985,600. That becomes the income tax for the year, 985,600. But we have made provisional payments. You already know about provisional payments. And the total provisional payments for the two provisional payments is 972,000. That is the provisional payments. So we then understand that we have made provisional payments of 972, yet the income tax amount is supposed to be 985,600. That means whatever we have paid provisionally is less than what we must pay over to SARS. To SARS, we must pay 985,600, but we have already paid 972 as provisional payment. So the question then is, Do we still owe SARS or SARS owes us? Do we still owe SARS or SARS owes us? In this case, it will be very easy for you if you will simply say, we must pay 985,600 according to the net profit that we have made, but we have already paid 972. So what does that mean? That simply means we still have to pay SARS. We still have to pay SARS. So we come now to our current liabilities. On our current liabilities, we are then going to come and say, here is our SARS income tax. SARS income tax. All right. We must pay SARS 985,600. This is the income tax that we are supposed to pay over to SARS, but we have already paid 972,000. Therefore, we are now only owing SARS 13,600. This is what we are now owing SARS. And once we owe, it becomes a liability. Hence, you see it under our current liabilities. We owe SARS 13,600. Okay. So remember all the calculations that we were doing from the start. We are now going to come and see all of that now on one statement. All right. So we have all our calculations and we end up now with our total current assets. Remember, we did this calculation. This one was given. So we have our cash and cash equivalents. We have our trade and other receivables, but we don't have our inventories. That is not a problem because we have already calculated this amount. We are fine over there. We have already done our non-current liabilities, our loan. We're okay over there. And then we have just closed off now our trade and other payables, which is over here. Our current liabilities is then complete. Remember, the current portion of loan we've done. We've just calculated SARS, shareholders for dividends. We did it already when we did our note number 8. All right. The amount for shareholders for dividends was already given. And then we have closed off our trade and other payables, which is that amount. So we're going to add, and then we get our 2,701,800. Then we add our total to get total equity and liabilities. Once we get our total equity and liabilities, the same amount here is what we then bring as our total assets here. So in this statement of financial position, you had to do it from the total equity and liabilities. Then that same amount, which is 14,174,250, you then bring it as your total assets, 14,174,250. Then you now say that 14,174,250, then you subtract your non-current assets. You end up now with your 2,715,750 being your current assets. Then you now say your 2,715,750 minus the 454,000 for cash and cash equivalents minus your trade and other receivables. Then you get your inventories, which they told us was the balancing figure. That would be the last calculation that you do in this question. It is very important, dear learners, that when you are doing your statement of financial position, you have to understand if you're told there is a balancing figure, that may be the very last calculation that you have to do as the balancing figure. So it is not always that you're going to balance it off here at the bottom. In this case, we had to end it off here with our inventories figure. And remember what we did today. We're able to calculate net asset value. What did we use? We used our ordinary shareholders' equity. So we were able to take the equity and we divided it by the number of shares for us to calculate our net asset value per share. For us to calculate our net asset value per share. All right. Now we have come to the end of today's lesson. In next week's class, I hope to see you, and I hope that you're going to bring your calculators and you're going to bring your worksheets as well. It is very important that you continue following, as next week we're going to do something totally different again. It is lovely to have you in my class. I can't wait to see you again next week, Friday, same time. We are here with our pens, our calculators, and our worksheets because this year is our year to shine. I hope to see you again next week. From me, it is goodbye.